So if you clicked on this, you're probably curious about how money is introduced into the economy through fractional reserve lending. Now, I know many of us have the view that the government decides to print more money into the economy as it sees fit, but the reality is far more complicated than this. We have a system where a nation's government and its reserve bank work together to control the monetary policy. I'll start by explaining how it works, and in the second half I'll talk about the history of how it got to how it works today. I'll assume that the majority of you tune out once you understand the how it works part, which is why I put the history of it in the second half. So anyway, the best way to explain anything is to give examples. So let's just say I started up a new country and it was called Happy Pig Land. I wanted the country to have a currency, so I started up a central reserve bank called the Piggy Reserve. And these are two separate entities. The Happy Land government wants to start the currency, so they issue some money out and everything is running well. But the government realizes it needs more money. So they sell government bonds which pay 5% interest per year. And if you don't know what a bond is, think of it like a term deposit where the government takes out a loan and they have to pay back whoever buys the bond. The biggest point of difference though is that instead of gradually paying the loan back, the entire sum will be paid back at the end of the period. So the government sells $1,000 of its new currency at 5% interest, and the Piggy Reserves buys it for $1,000. The $1,000 is then lent out to some smaller banks who then lend it out to businesses and individuals. Out of the $1,000 the bank has, they may have a fractional reserve policy of maintaining a 10% reserve ratio. This means that they can lend out $900 for every $1,000 that they have deposited in them, leaving $100 being 10% just in case the lenders want to withdraw the money. In the real world, there is no fractional reserve limit, and the ratio is at the discretion of every individual bank. So, out of getting the $1,000 in cash, there is now $1,900 in circulation because the $1,000 was deposited and then that bank is allowed to lend out $900. Now, I know this seems a little bit crazy, but this is just the beginning of the Inception style ride that I'm about to take you on. So, with that $900, let's say that the money is used to be deposited into another bank. That second bank could then lend out $810 from that $900 deposit using that same 10% rule. To cut a long story short, if this process were to be repeated 20 times, you could create roughly $16,000 of a currency out of creating just $1,000 in government bonds. Now obviously in the real world, it's a bit different to this, as a fractional reserve rate will not always be 10%, and everyone who borrows the money is just not going to be depositing it straight into another bank. But I've attached this picture here just so you can basically see how many times it gets reused and re-lent out, how far that money can go. So anyway, back to the land of happy. Let's say that for whatever reason there is a financial panic. There are fears that everyone will be wanting to withdraw the money from the bank at the same time. Furthermore, no one is trading for one another and the economy is grinding to a halt. So, what can be done? Well, I, as the piggy bank, can tell the government, hey, if you create a bond that pays 2.5% interest rather than 5% interest, I'll happily buy that from you. So, the Happy Land government creates a new government bond for $1,000, and the Piggy Reserve infuse the government with $1,000 immediately, and they collect that small interest rate. And now, that encourages a stimulus of economic activity. More people will take advantage of the cheaper interest rates by starting or expanding businesses or increasing consumer spending. And let's just say the following year that Land of Happy has created a new economic bubble from all this stimulus, and the government approaches the Bank of Piggy to buy more bonds. But the Piggy Reserve, or I might be a bit concerned about this potential bubble. So they say, sure, that's okay, but the new interest rate is 7%. So the government then buys that bond, and this will have a flow-on effect as the population will become more sensible of borrowing money as they know that the interest rate is higher than what it used to be. And now you're probably thinking, why does the central bank even need to exist? Why can't the government just choose to issue its own money? Well, I can't really give you a good answer for that. And there are many Austrian economists out there who state that we can simply cut out the central bank and just have the government operate the currency directly. And the United States actually did this for a long duration in the 1800s. But if I go too deep into this topic, I may accidentally move into the realm of being an information video into a conspiracy video. So I'll just keep things to where they are here. And I do know that there are some benefits to having a financial system which is insulated from the political whims of bad leaders. The leadership of the reserve banks are people who have spent their lives working in academia and in banking. They know what they're doing and they've spent their lifetimes getting to be the heads of the reserve banks. It is similar to how leaders of any decent military will rise up the ranks and not just be appointed from the outside. Therefore, the financial system is insulated from potential populist leaders who will make dramatic statements, while also have zero comprehension of the consequences of their proposed ideas. And whatever your political ideology is, I'm sure that we can all be grateful that a certain elected leader did not have direct control of the nation's monetary policy at some point in its history. Now, monetary policy is right up there with defense as kind of a big important thing to get right. In the same way that you do not want a politician to fire a 5-star general and replace him with a crony who has never served, we do not want politicians doing a similar thing to a monetary chain of command. So now, let's just get to the second part of the video and we'll talk about the history of how things came to be the way they are. This fractional reserve lending system was started in 1609 by the Bank of Amsterdam, and it is basically the ancestor to all of the world's central banking and reserve banks today. They traded banknotes for what could be directly exchanged for a preset amount of gold and silver. Gold and silver were the preferred items to trade back then, but they were too hard to precisely weigh and carry for everyday transactions like your grocery shopping, for example. So banks started up a concept where you could store gold and silver and then issue tokens to redeem those metals if needed. These tokens, or currency, would then be traded by everyone in day-to-day commerce. But after some time, the banks realized that they could issue more tokens than what they actually had in stored gold and silver, as the chances of everyone wanting to claim their precious metals was pretty low. And even though the chance of everyone wanting to take their deposits out at the same time, it was not impossible. Especially if a rumor were to start where the banks are about to run empty, and then this will cause everyone to basically try and withdraw the gold at the same time. So, to cut a long story short, although the risk was low, it was not impossible. The banks banded together and they made a special bank, or a bank for the banks. And this would mandate a standard for all the banks to comply with, and also spread the risk of a run on the bank for any individual bank, as the collective banks would have their backs to support one another. That explains fractional reserve lending, and don't forget to like and subscribe. Thanks, bye.